What is a bear market? A bear market is when a market experiences prolonged price declines. It typically describes a condition in which securities prices fall 20% or more from recent highs amid widespread pessimism and negative investor sentiment. Bear markets are often associated with declines in an overall market or index like the S&P 500. But individual securities or commodities can also be considered to be in a bear market. If they experience a decline of 20% or more over a sustained period of time, typically 2 months or more. Bear markets also may accompany general economic downturns such as a recession. Bear markets may be contrasted with upward trending bull markets. Understanding bear markets. Stock prices generally reflect future expectations of cash flows and profits from companies. As growth prospects wane, and expectations are dashed, prices of stocks can decline. Herd behavior, fear, and a rush to protect downside losses, can lead to prolonged periods of depressed asset prices. One definition of a bear market says markets are in bear territory when stocks, on average, fall at least 20% off their high. But 20% is an arbitrary number, just as a 10% decline is an arbitrary benchmark for a correction. Another definition of a bear market is when investors are more risk-averse than risk-seeking. This kind of bear market can last for months or years as investors shun speculation in favor of boring, sure bets. The causes of a bear market often vary, but in general, a weak or slowing or sluggish economy, bursting market bubbles, pandemics, wars, geopolitical crises, and drastic paradigm shifts in the economy, such as shifting to online economy, are all factors that might cause a bear market. The signs of a weak or slowing economy are typically low employment, low disposable income, weak productivity, and a drop in business profits. In addition, any intervention by the government in the economy can also trigger a bear market. For example, changes in the tax rate or in the federal funds rate can lead to a bear market. Similarly, a drop in investor confidence may also signal the onset of a bear market. When investors believe something is about to happen, they will take action, in this case, selling off shares to avoid losses. Bear markets can last for multiple years or just several weeks. A secular bear market can last anywhere from 10 to 20 years and is characterized by below-average returns on a sustained basis. There may be rallies within secular bear markets where stocks or indexes rally for a period, but the gains are not sustained, and prices revert to lower levels. A cyclical bear market, on the other hand, can last anywhere from a few weeks to several months. The U.S. major market indexes were close to bear market territory on December 24, 2018, falling just shy of a 20% drawdown. More recently, major indexes including the S&P 500 and Dow Jones Industrial Average, fell sharply into bear market territory between March 11 and March 12, 2020. Prior to that, the last prolonged bear market in the United States occurred between 2007 and 2009 during the financial crisis and lasted for roughly 17 months. The S&P 500 lost 50% of its value during that time. In February 2020, global stocks entered a sudden bear market in the wake of the global coronavirus pandemic, sending the Dow Jones Industrial Average down 38% from its all-time high on February 12, 29,568.77, to a low on March 23, 18,213.65, in just over 1 month. However, both the S&P 500 and the Nasdaq 100 made new highs by August 2020. Bear markets usually have 4 different phases. The first phase is characterized by high prices and high investor sentiment. Towards the end of this phase, investors begin to drop out of the markets and take in profits. In the second phase, stock prices begin to fall sharply, trading activity and corporate profits begin to drop, and economic indicators that may have once been positive start to become below average. Some investors begin to panic as sentiment starts to fall. This is referred to as capitulation. The third phase shows speculators start to enter the market, consequently raising some prices and trading volume. In the fourth and last phase, stock prices continue to drop, but slowly. As low prices and good news starts to attract investors again, bear markets start to lead to bull markets. Bear and bull. The bear market phenomenon is thought to get its name from the way in which a bear attacks its prey, swiping its paws downward. This is why markets with falling stock prices are called bear markets. Just like the bear market, the bull market may be named after the way in which the bull attacks by thrusting its horns up into the air. Bear markets versus corrections. A bear market should not be confused with a correction, which is a short-term trend that has a duration of fewer than 2 months. While corrections offer a good time for value investors to find an entry point into stock markets, bear markets rarely provide suitable points of entry. This barrier is because it is almost impossible to determine a bear market's bottom. Trying to recoup losses can be an uphill battle unless investors are short sellers or use other strategies to make gains in falling markets. Between 1900 and 2018, the Dow Jones Industrial Average had approximately 33 bear markets, averaging one every 3 years. One of the most notable bear markets in recent history coincided with the global financial crisis occurring between October 2007 and March 2009. During that time, the Dow Jones Industrial Average declined 54%. The global COVID-19 pandemic caused the most recent 2020 bear market for the S&P 500 and Dow Jones Industrial Average. The Nasdaq Composite most recently entered a bear market in March 2022. On fears surrounding war in Ukraine, economic sanctions against Russia, and high inflation.